Hey guys, I wanted to take this opportunity to remind you all to like and subscribe. It really helps me to keep getting the best guests onto the podcast. So I really appreciate it if you did. And now onto the video. Um, Now, a lot of people have attributed the rise in commodities to inflation caused by central bank printing, while a lot of other people have said, there's no real inflation, nothing's going to happen. So, what are your thoughts on that? Do you think inflation is going to come? And, do you think that, over the next, say, 3 to 5 years, we might see some stagflation with both inflation and unemployment pretty high?
Yeah, inflation is such a funny and interesting topic in the financial community. It drives everyone seems to talk about it, but um, it's never inflation. It's such a fascinating topic because everyone has a different view of it. What causes it? To me, what ultimately causes inflation is persistent demand. So the most basic leading indicator that you can put together that has an unbelievable hit rate and sort of view is if you overlay the ISM with CPI, the ISM leads by about 18 months. So whatever the ISM is effectively growth, right? So whatever the ISM does, 18 months later, that's where you get core CPI prices. Now, I think as an asset, as someone that's active in markets, the thing you want to pay attention to, though, is the break-even market. Because the break-evens, as I just explained, right, are driving these equity multiples. It's not CPI. No one knows what the monthly CPI number is going to be. That's not driving, right? It's the on-the-ground today demand, and primarily for commodities. So the thing that I'm wrestling with right now is I think the dollar is likely biased higher, but I can see a scenario if the scenario where it just continues lower happens, then you'll likely get higher inflation via commodities. And I think that's the highest probability outcome over, call it 2 to 3 years. You'll get inflation via these commodity prices versus it's effectively increased demand because everything's priced in dollars. As the price of dollar goes lower, then those commodities are, cheaper to consume. So look, right now, I do not think we have the banks are tightening credit, right? So a significant amount of banks are tightening mortgage credit, credit card lines. Capital One just cut their credit card lines. Those are not typically the things you want to see for persistent higher inflation. You want to see that going the other way. You want to see credit conditions easing. And you're seeing the same thing in Europe. Some of the credit conditions are tightening. So you're having a tightening in the real economy, but a loosening in the financial markets because of what the Fed has done with a lot of their asset purchases as well, especially in the corporate bond market. So this dichotomy, I think, gets solved over the next few months. And as we get into next year, then you could likely see some of the, pickup in inflation going forward. But I do not think what they've done currently is very. If they can, let me phrase this correctly. If they consistently do stimulus programs like they've been doing, I think that's extremely inflationary. If they're able to constantly pump out money like this and keep rates this low, that's unbelievably inflationary. Now, if this is a one-off, we're having a difficult time passing this needed stimulus right now because of what's going on in Congress. If that changes after the election, the Democrats take both the House and Senate and the presidency, then there's a scenario where we could have a lot of inflation and some pretty remarkable moves in markets, which would be so much fun to trade. And that's sort of, I think also the iteration of policy is likely, the probabilities of the next iteration of policy are moving closer to those outcomes, maybe not that extreme, but more, government fiscal sort of spending and some economic handouts, which is very negative, I think, for asset prices, but very positive for commodities, which is a trade that I'm thinking about over the next 3 to 5 years.
Can you say that last bit again?
Yes, which the why it's negative
Yes.
for asset prices.
Yes. And
So
positive for commodities.
so if you think about these programs, in order to hand out money to individuals, you need to finance that somehow. In terms of financing that, you need to basically issue treasuries, and by issuing treasuries, that takes money out of the system. So you're saying, okay, we need to raise $10. So you go to everybody in the system and say, hey, guys, we need $10. So either the people that have cash give you that $10, or people that have equities have to sell that equity and give you basically those dollars. But you need to someone needs to give you those $10. A way to do that is if the Fed buys it. But right now, based on what they've said, they're not increasing their purchases. So every incremental stimulus package needs this money coming out of the market. However, at the same time, that is then going to consumers that are buying goods. And those consumers buying those goods are causing the prices of those goods to rise because now they have more money. So on top of this, if you have, these goods and be like, for example, what's happened recently in the durable goods, right? Then inflation is likely going to pick up and interest rates are likely going to go higher. And if that happens, that's very bad for technology.
Correct.
And the whole industry on the equity front has a huge deflationary trade on right now with the overweights of tech. The amount of capital that has flown in technology that is overweight technology is just mind-boggling. So on the S&P, for example, right now, $11.5 trillion of the market cap of the S&P is tech, which is around 30%. Industrials and materials, energy and materials are roughly, I believe, about 2 trillion, maybe a little less than that. So if you have constant stimulus, there's money coming out of tech. It's likely because of the sheer size of technology, it's likely going to spread across some of these other very small sectors. Like energy, for example, is 2 points of the S&P now, which is just insane. It's like not even it's like a rounding error. So to my mind, the probabilities of going forward are a lot of these beaten up sectors. This is more as we get into next year. I think we're still in a period of negative liquidity and we're a little on the difficult front. But these, sectors I think have a lot more upside given the higher increasing probabilities of what we saw recently continuing to happen. And if that continues in perpetuity, then we're absolutely going to get inflation. Because that would therefore cause demand to consistently increase, right? And as demand consistently increases,
prices go higher.
Exactly. And what's happened recently, right, is there has been a huge amount of demand, but there's also a very big supply element to it. So as the supply normalizes, it's likely the commodity prices will either chop around or come down, which would weigh on inflation, as opposed to consistent demand, right? That would cause inflation to rise. So yeah, increasing in large scale increase in treasury issuance would be negative for risk assets, but positive for commodities. And also dollar negative, which therefore would be dollar negative, which would be positive for commodities also.